DIY investor Daniel Pronk is a popular voice on YouTube, but we're about to put his stock savvy to the test. We're challenging him to defend 3 of his biggest positions in his portfolio, and he's got just 6 minutes to do it. So can he beat the clock and stand up to scrutiny? Well, we're about to find out. This is Inside My Portfolio. Welcome to Inside My Portfolio, where we challenge financial influencers to defend their top investments in a race against the clock. And along the way, help you learn how to make smarter investing decisions of your own. I'm your host, Rob Moise, and joining us is DIY investor Daniel Pronk. He's a seasoned stock picker who shares his approach to over 270,000 subscribers on YouTube. Daniel, welcome to the show. Great to have you.
Thank you for having me. It's great to be here.
Daniel, can you tell us a little bit about who you are as an investor, your investing style, your risk tolerance, some of your investing goals and stuff like that before we dive into your portfolio?
Yeah, absolutely. I would say for me as an investor, I am more focused on investing in real world physical assets that I think are going to be in demand and be around for, decades to come, the things that the world really relies on. I would say that my risk tolerance is medium, for the sole reason that I do tend to have a more concentrated portfolio. So I think that there is a little bit more risk with, having less positions and more concentration in my portfolio. And then my goals, my short-term goal is to outperform the S&P 500. And then my long-term goal, financially, is to eventually live off of my portfolio comfortably, where I don't have to take money out and I can kind of just get passive income from my portfolio to pay all of my living expenses if I choose to.
The passive income dream, everybody wants it, and you're on your way to getting it. But tell me though, how come you decided to be a stock picker rather than just, take the path of least resistance and invest in things like index funds like so many other investors do?
Yeah, so for me, I genuinely love investing. It's just something that I love doing. I love analyzing businesses. I find it super interesting. I'm one of those guys where every single night I'm reading 10Ks, financial statements, shareholder letters, and I'm just trying to learn as much as I can about businesses, and I find it fun. It's kind of weird, but it's something that I just love doing. So index investing for me just isn't as fun, not as challenging. And that's not to knock index investing. I actually think index investing is the best for the vast majority of people, but just for myself, I enjoy picking stocks better.
Embracing your inner finance nerd. I love it, Daniel. Well, we're going to get inside your portfolio and see what your stock picks look like. You got 3 stocks, 2 minutes apiece, 1 unforgiving countdown timer, and no holds barred. Before we get rolling, though, a quick disclaimer for our viewers. We're going to ask Daniel about some of the investments that make sense for him based on his unique investing style, time frame, risk tolerance, and goals. They may not make sense for others in the audience and shouldn't be seen as financial advice. The idea here is to give you some food for thought on how an everyday DIY investor makes his investment decisions to help you ultimately make your own. With that said, Daniel, let's start the clock now and get into it. So the first stock that we're going to discuss is Brookfield Corporation. Ticker symbol is BN. Why do you hold it? What is it? Tell us about it.
Yeah, for sure. Brookfield Corporation is the parent company of the entire Brookfield ecosystem. So they're the parent of Brookfield Asset Management, Brookfield Infrastructure Partners, Brookfield Renewables. And the entire investment thesis for Brookfield centers around the fact that they invest in real assets, things that the global economy absolutely relies on, like real estate, pipelines, data centers, electric utilities, hydro dams, nuclear power plants, everything that the world needs to run. They even have some of their own railroads in their portfolios. And these types of assets, as I said earlier on, I think are going to be in demand for basically ever. So as long as the world needs more energy, needs to move goods across the economy, I think that Brookfield's business is going to be around and producing a growing stream of cash flow.
There's a lot of concern, though, about a potential AI bubble, and Brookfield has got some pretty heavy investments in energy projects tied to AI and stuff like that. Why are you not concerned about that exposure?
Yeah, I would say that this is one of the largest concerns with Brookfield and the entire AI sector right now. And from what we have heard from Amazon, Microsoft, and all these types of companies, is that the demand is very, very real. They're seeing real positive impacts using AI in their own businesses. And their customers are also seeing real positive impacts in their businesses as well. So I think that the demand is very strong. And it's backed by the fact that AI is having a tangible positive benefit on business fundamentals.
Okay, Daniel, less than 30 seconds left, but Brookfield's price to earnings ratio, last I checked, was a whopping 82. It's roughly double the average of its peers. Why are you not concerned about overvaluation here?
Yeah, so for Brookfield, they're a conglomerate business, kind of like Berkshire Hathaway, slightly different. And for these types of conglomerate companies, reported earnings and price to earnings ratios just simply don't make sense because they have so many assets on their balance sheet where they may own 20% of a business.
Yeah, that's time. But you almost got it, Daniel, but yep. we take it. Let's get to our next one then. This one is Main Street Equity. Tell us about it. Why do you hold it? What is it?
Main Street Equity is a very simple business. They are a serial acquirer of apartment buildings across Western Canada. They own over 19,000 apartment units now. And basically all the business does is they buy distressed apartment buildings that are being mismanaged, not being renovated, not being kept up. They buy them for cheap, they renovate them, they refinance them, take that cash out of the building and go and buy some more. They've been doing this for 25 years and they've grown a portfolio worth over $2 billion and they have 19,000 units now.
Daniel, are you not at all concerned, though, that the best days of Canadian real estate are behind us, just given that we've seen home prices and rental rates slump in the last year or so?
I would say there's always a risk that we could see a little bit of a downturn in the real estate market. But the thing about Main Street Equity is they're providing very affordable housing. Their average rental rate per month is $1,250 per month. So their real estate is always in demand, and they're actually still seeing their per unit rental rates grow even through a tough economy. So I think that they're a little bit more insulated.
But I mean, we're seeing the feds talk about wanting to improve housing affordability, reducing immigration to some extent. Do you not see that potentially squeezing Main Street's profit growth?
I think that reduced immigration and lower population growth could, but you cannot build a new apartment building today and have that apartment building be profitable at $1,250 per month. So the new supply coming on, you have to charge at least $3,000 per month in most economies across Canada to make it profitable, which simply is not really competing with Main Street Equity's average rental price.
And what about the idea that these properties that they own are often in like these little mid-market cities in Western Canada, very susceptible potentially to like an economic downturn with the price of oil and stuff like that? Are you not concerned about that risk with all the geopolitical uncertainty right now?
I'm not. And cyclicality actually works to Main Street benefit because when the economy is down, they can actually acquire more real estate for cheaper prices. This is something they did in 2008, 2016 in Alberta.
All right, you got it. You're getting almost as much of your thought out there, but that's good. Let's get to the last one, TerraVest. What is it? Why do you hold it?
TerraVest is a serial acquirer of very boring industrial businesses. For example, they make furnaces, and they also have another business that makes literal tanks that go on the back of trucks, and also things like natural gas tanks for even data centers to just store natural gas. The thesis here really is that this business is buying all of the boomer businesses, if you want to call them that, just businesses that are very profitable, not necessarily growing, but no one wants to own them. And TerraVest is the company buying all of these up.
TerraVest management, though, has warned about the impact of tariffs on some of their core industrial businesses. We've already seen the sales fall, the margins compress a little bit. What gives you confidence that they're going to be able to get through these headwinds?
Yeah, I think that these are all just short-term headwinds, and the business has done an incredible job growing very, very rapidly through historical headwinds. So while there could be a short-term impact, again, this is a serial acquirer business. So if there is weakness in the economy, they can just buy up more assets for cheaper and get higher returns on their capital. So these types of businesses actually benefit from a down economy because they can acquire more for cheaper.
The other thing that I noticed, though, about their balance sheet is they have very little cash on hand to cover even some of their near-term debts. This could make them pretty vulnerable in an economic downturn or some kind of financial shock. Why are you comfortable with that risk right now?
I would say I'm comfortable with it because they have a low debt to EBITDA ratio in general. And also this business is producing a significant amount of true cash flow. So while they may not have a lot of cash right now, over the next year, they're going to make, close to $200 million in cash. So I think that they're pretty liquid and they have profits coming in.
Real quick, Daniel, 20 seconds left, but public disclosures show that TerraVest insiders sold over $50 million worth of shares in the past 12 months. Is that not a screaming red flag that they see trouble ahead?
I would say no. These guys own a significant amount of the shares. Just go take a look at the share price. I think that they deserve a little bit of a payday.
Okay, so getting out while the getting's good. Okay, that's fair. And hey, you beat the clock. Excellent job, Daniel. How did you feel under the pressure of the clock?
Good. It's challenging to talk that quick and try and get all the thoughts out, but it's fun.
I think you did an amazing job. I think we could throw like 10 stocks at you and you'd be able to prattle them all off, but unfortunately that's all the time we have for this time. But really appreciate you taking part, having a lot of fun.
Yeah, thank you. It was fun. Happy to do again anytime.
Right on. And for those watching, of course, if you want to get started building a stock portfolio just like Daniel, then consider investing with TD Easy Trade. You get 100 commission-free stock trades. You get partial shares to help you put every dollar to work ASAP. And of course, your choice of TFSA, RRSP, FHSA, and cash accounts. Plus, going on right now, you can get $100 worth of partial shares for free if you deposit $2,500 or more into a new account before the end of June. What's not to love about that? Scan the QR code on screen for full details. That's it for this edition of Inside My Portfolio. Thanks for tuning in. We'll see you all next time.
Have more questions? Check out the links to the right and in the description below.